Joining us right now is Gabriela Santos. She is Chief Market Strategist for the Americas at JPMorgan Asset Management. And Gabriela, why don't we just start with yesterday's new highs, despite the government shutdown? We know that government shutdowns often don't affect the markets. In fact, you tend to see the markets trade up. But what is happening? Is this a case where we're looking at this thinking this will be resolved quickly, thinking it doesn't matter what you're seeing from spending when it comes to AI is far more important?
I think the expectation for investors is it won't last too long. Perhaps 2 weeks is currently what we're hearing. And that for stocks, you'll still have actually enough data because we will get the earnings season kicking off in less than 2 weeks. And that's really where I think we're very eager to hear from companies 2 things around AI, of course, that eternal question around return on investment and by how much some of these large mega cap tech companies are beating earnings. So that is an important risk and an important data point that we will have. The second question for the rest of the market is all around margins. How much are companies able to pass on or reduce costs other ways when it comes to especially tariffs and especially for some of the more cyclical or even smaller cap areas of the market? Expectations are pretty high right now in terms of margin expansion for the rest of this year and into next year.
It almost sounds like you ignore the part of the economy that is based on the consumer, that we're not sure exactly how the consumer is doing. We want to hear some thoughts on that, but it's going to be hard when you're not getting any government data to go along with that.
I think what's been interesting is actually the consumer has been stronger than we had expected. We had that GDP revision data recently last week, which usually is a snooze, but it actually showed us that consumption or real domestic demand grew at 2.6%, not 1.6%. So actually better. And we had already heard that those little tidbits from companies in the second quarter earnings season. For this third quarter, I think it depends on the sector you're looking at. For financials, the consumer is doing good enough.
Okay.
It's not seeing defaults. That means banks can actually reduce some of the excess reserves they had built up. They don't have to have huge default expectations. But if you're investing in more consumer discretionary or even consumer staples companies, then the consumer being a little bit cool, a little bit picky is very, very important. And there we're still quite skeptical that some of the summer rebound and some of those consumer names continue. It's still a soggy consumer, still a picky consumer. It's not a rising tide that lifts all boats there.
How are you feeling about the labor markets? We got that ADP number that was weaker than people had been anticipated, but it was based on some revisions.
In terms of the labor market, I think usually we don't look at ADP, a really bad predictor of the first print of the BLS report. But actually, during the last year or so, it's been much more accurate and timely in showing us that the labor market was cooling, which later on the BLS ended up showing in its revisions. And what it's showing us with the negative print yesterday is that this was the third negative print in 4 months. So it is showing that there was a little bit further cooling in the labor market into September versus what we were expecting. So I think the bond market yesterday and the dollar were reacting more to the fact that actually maybe the Fed has enough data points to still cut again in October.
What does the Fed do in October if they don't have government numbers?
I think for them, they usually look at a mosaic of labor market data anyway. I think for them, maybe they have enough data points with ADP, with taking the JOLTS that was also released on Tuesday with 1 month lag, but an important data point in the overall picture to say, look, that cooling is still happening in the labor market. The risk is it cooled further. This still gives us a green light to cut on October 29th, but by 25 basis points. I don't think you've gotten new data points to justify 50.
So what do you tell investors to do right now? We're at new highs. You tell them to keep buying stocks at these levels?
So for equities, I think what's a little bit concerning to us is that at 22.8 times, we're at some of the highest PEs since the late 90s, having passed the 2022 numbers. That doesn't mean anything about where stocks are going to go next month, but it does tell us that more extended valuations, any disappointment can certainly be quite penalized. So there comes the earnings beats as one of the main risks for the market, in my opinion, in terms of the mega cap tech stocks. So just be more aware about the potential for some downside, like we saw in February and March. So for AI, we keep reminding our clients that the technology is transformative, just like it was with the internet, but that the winners of today won't always be the winners of tomorrow. 6 of the top 10 companies today weren't there in 2005. So it's an evolving theme. We're already seeing that this year in the markets. There are other tech winners. There are other real economy winners. And actually, our clients are increasingly moving more to look at private markets as another source of investing in the AI theme, whether it's certain types of software and private equity or whether it's utility and power in infrastructure.
So the BLS knew that September was already over before the government shutdown. So does the BLS have all the data? They just haven't compiled it. Do they need to be? Does the government need to be open to release the data or to compile the data? And the Fed knows.
Are they essential workers? Do they go in and work?
Well, if the Fed knows, does the Fed know beforehand? Does the Fed know what these numbers are anyway? And doesn't need? Is it the actual release that the government doesn't allow because of it's shut?
They're not going to get the numbers if we're not releasing it, though, right?
I would think that they would have fully know anecdotally what's going on in September.
That is a good question for Scott Bessent.
I mean, I would think they fully know, but then again, they've fully known all along and have no idea what they're doing. And also the numbers that they've been using, because of the way that the surveys are done now, are open to huge revisions anyway. So the data it's not that great anyway that they're not getting.
Yeah, but it is important to have a fuller picture. But absolutely, the ADP has been a better predictor anyway, and we did get that. I do think the BLS has the data for specifically this jobs report and jobless claims, right, for today that were supposed to be released today. The question is more CPI. October 15th, right. The collection would still be happening right now, and it isn't. And so then you could get a delay.
So the numbers that we get later are not going to be accurate because the surveys won't have been done.
Or they will be delayed. Their release will be delayed. I remember that happening in 2013, for example, because really it's...
When the government was shut for 30-some days. Was it?
I don't remember 2013, but...
I think 2018 was only a few days. I think 2013 was longer.
Was a bit longer. Yeah. But I think the broader point to Joe's question is it's up really to the budget director to decide what is essential, what isn't. It was essential in 2018-19, so we did get data. It was not essential back in 2013 and not right now. So very much at the discretion. We do think, by the way, for jobless claims that we might actually be able to compile something on Friday when the state level data is released. So there are certainly creative ways around trying to get a better understanding of where we are. If anything, I think for inflation is where it's going to get a bit trickier.